This is Sovrun, your guide to financial literacy. Today we're talking about why the impossible keeps happening. In March 2020, the S&P 500 dropped 34% in 23 days. Statistically, that was a 25 standard deviation event, something that should happen once every, never. Yet here we are. And it wasn't the first time. Kurtosis explains why these impossible crashes keep showing up. Kurtosis tells you how likely extreme surprises are. Most days, markets move a little, boring, normal stuff. But every once in a while, something crazy happens. Kurtosis measures how often crazy shows up. Think of two cities and earthquakes. City A gets small tremors regularly. The ground shakes a bit, life goes on. City B is quiet for years, then gets hit by a magnitude 9. Standard deviation tells you the average shake. Kurtosis tells you how likely the big one is. Here's how the numbers work. A normal bell curve has a kurtosis of 3.0. That's the baseline. We usually subtract 3 to get excess kurtosis. So normal equals 0 excess. Now here's the reality. The S&P 500 daily returns have a kurtosis of about 25. That's an excess kurtosis of 22. That means extreme market days, the really good and really bad ones, happen far more often than a bell curve predicts. This is why once-in-a-century crashes seem to happen every decade. The bell curve says they're impossible. Kurtosis says they're inevitable. Let's see this across asset classes. U.S. bonds, excess kurtosis around 4, mild fat tails. Commodities, about 12, more surprises. The S&P 500, 22, extreme days are the norm, not the exception. Bitcoin, 35, the wild west of fat tails. And individual stocks can hit 40 or above. The further from zero, the more you should expect the unexpected. Every asset class has fatter tails than the bell curve predicts. Long-term capital management, LTCM, is the ultimate kurtosis story. Run by 2 Nobel Prize winners, their models assumed normally distributed returns. Kurtosis of 3. When the 1998 Russian debt crisis hit, markets moved 4 to 5 standard deviations in a single day. Their models said that should happen once every several billion years. LTCM lost $4.6 billion in less than 4 months and nearly brought down the entire financial system. The lesson? Kurtosis isn't an academic curiosity. It's a survival metric. Here's the dangerous truth. Most financial models still assume normal distributions, but real markets have fat tails. Ignoring kurtosis is how banks underestimated 2008 and how LTCM blew up in 1998. The impossible happens more than you think. Are you prepared? And kurtosis isn't just for finance. It's used in earthquake seismology for predicting extreme quakes, insurance for pricing catastrophic events, and climate science for extreme weather frequency. Follow Sovrun for more financial insights.